Imagine waking up one morning only to find that the wealth your family spent decades building, your savings, your investments, your security, has vanished. Not because of war, not because of a natural disaster, but because of the invisible forces of the financial system, a system you thought you could trust, a system you thought was stable. What if I told you that millions of Americans lost everything not because they were reckless, but because the very institutions designed to protect their wealth, the banks, the stock markets, and even the government, failed them in ways no one expected? And yet even today, many people believe that what happened in 1929 could never happen again. But the truth is far more disturbing. Patterns repeat. History rhymes. In this video, we're going to unravel the story of the Great Depression, exploring how Wall Street wiped out generational wealth, why ordinary people were powerless to stop it, and what lessons it holds for anyone managing money in our own volatile economy. To understand how wealth disappeared so suddenly, we first need to step back to the roaring 1920s, a decade of unprecedented prosperity, boundless optimism, and, as we'll see, dangerous illusions. The United States had just emerged from World War I and the economy was booming. Industries like automobiles, radio, and construction were expanding at lightning speed. Stock prices soared, fueled by speculation, easy credit, and a sense that the economy was invincible. Key figures loomed large in this period. Investors like Charles E. Mitchell of National City Bank encouraged Americans to borrow money to buy stocks. Corporate leaders flaunted their wealth in ways that captured the public imagination, while the general populace believed that the stock market was a shortcut to financial security. Banks themselves had become entangled in the stock market. Unlike today, commercial banks were heavily involved in lending for stock purchases. Investment trusts, which pooled investors' money to buy stocks, promised incredible returns but were opaque and highly leveraged. And here's the first twist. What seemed like prosperity was actually built on unstable foundations. Debt was increasing faster than income. Stock prices were inflated far beyond their real value, and most Americans didn't own much stock directly. They were investing through banks and trusts, which made the system fragile and deeply interconnected. But the public didn't know that yet. They only saw headlines of soaring wealth and rising dividends. The mystery was, how could something that seemed so unstoppable collapse so completely? The seeds of disaster were planted years before the crash. Several interrelated factors set the stage. Speculative mania. Ordinary Americans were encouraged to buy stocks on margin, borrowing up to 90% of the purchase price. This meant that even small declines in stock value could trigger massive losses. Unequal wealth distribution. By 1929, the top 0.1% of Americans controlled as much wealth as the bottom 42%. Most people had little savings and relied on their wages, leaving them vulnerable to economic shocks. Overproduction in industry. Factories were producing more goods than the public could buy. This led to layoffs and shrinking demand, which in turn made companies look less profitable on paper, a dangerous signal to investors. Weak banking regulations. Banks were undercapitalized and largely unregulated. They often invested depositors' money in the stock market and engaged in risky lending. When confidence faltered, there was no safety net to prevent a cascade of failures. Global debt and reparations. Europe was still recovering from WWI, with Germany burdened by reparations. American banks were heavily invested overseas, tying domestic stability to fragile international markets. The story isn't simple. It's a chain reaction. Each factor alone might have been manageable, but together they created a system primed for collapse. And yet, most Americans and even many bankers assumed the good times would continue forever. Throughout the 1920s, the stock market appeared unstoppable. Industrial indices doubled, then tripled. People saw neighbors making fortunes seemingly overnight. Margin accounts became the norm, and banks lent freely. But cracks were already appearing. Analysts warned that stock prices were out of sync with company earnings. Certain sectors like railroads were stagnating. Some banks began quietly tightening credit, sensing trouble ahead. Yet the excitement, greed, and fear of missing out, the classic human emotions that drive markets, overpowered caution. The story reaches a critical point in October 1929, but to fully understand the crash, we must grasp the psychology of the boom: collective overconfidence. Investors were no longer evaluating companies rationally. They were speculating on speculation itself. This is where Wall Street's power becomes almost cinematic. It could bend public perception, manipulate prices, and encourage risky behavior, all under the guise of prosperity. The breaking point came in late October 1929, known as the Wall Street crash or Black Tuesday. Stocks plummeted. Margin calls forced investors to sell. Banks that had lent to stock buyers began to fail. Panic spread like wildfire. The domino effect was brutal. One failure triggered another. Millions of ordinary Americans who had bought stocks on borrowed money saw their assets wiped out overnight. Generational wealth, homes, savings, family businesses evaporated. But here's the nuance many overlook. It wasn't just the stock market. Bank runs amplified the crisis. Between 1929 and 1933, over 9,000 banks failed, taking deposits with them. Savings that families had painstakingly accumulated disappeared. The narrative of lost wealth is not abstract. It was intensely personal. Entire communities were financially decimated. Farmers lost their land. Urban workers lost their jobs and savings. Pensions and insurance schemes collapsed. The lesson? Wealth is fragile when trust in the system breaks down. Even carefully accumulated money is vulnerable if the institutions managing it fail. The Great Depression's consequences went far beyond the financial sector. Unemployment. By 1933, nearly 25% of the U.S. workforce was unemployed, leaving millions in poverty. Deflation. Prices dropped dramatically, worsening the economic spiral as debt burdens became heavier in real terms. Global impact. The Depression spread worldwide, destabilizing economies in Europe, Asia, and Latin America. Social consequences. Families were uprooted, communities strained, and trust in banks and government institutions eroded. Government interventions initially failed. The Federal Reserve, constrained by its policies and ideology, did little to expand liquidity. Tariff policies like the Smoot-Hawley Act worsened trade. Efforts to balance budgets and maintain the gold standard only deepened the crisis. It wasn't until Franklin D. Roosevelt's New Deal programs, public works, Social Security, bank reforms, that a partial recovery began. But even then, the scars lasted for decades. Even after reforms, some mistakes persisted. Over-reliance on government intervention led to debates over fiscal policy and regulation that continue today. Moral hazard. Banks became aware that future bailouts were possible, reinforcing risky behavior. Human behavior unchanged. The fear-greed cycle repeats. People overborrow in booms, panic in busts. This cycle is exactly what makes the Great Depression relevant today. Financial systems are bigger, faster, and more complex, but human psychology hasn't changed. Consider recent financial crises. 2008 financial crisis, subprime mortgages, complex derivatives, bank failures, eerily reminiscent of 1929. Millions of Americans lost their homes and savings just as they did in the Great Depression. Cryptocurrency bubbles. Speculation drives prices far beyond fundamentals. People borrow to invest, reminiscent of margin buying in the 1920s. Income inequality. Wealth concentration today mirrors the 1920s, making society more fragile to shocks. Shocking data. According to some studies, the top 1% today control as much wealth as the bottom 90%, creating a fragile system susceptible to sudden collapses, a pattern that repeats in every major financial crisis. The lesson is clear. Without understanding history, we are doomed to repeat it. The same mechanisms that erased generational wealth in 1929 are still present, albeit in new forms. Wealth is fragile. Even carefully built financial security can be wiped out when systems fail. Human behavior drives crises. Greed, speculation, and herd mentality are timeless forces. Learn from history. Understanding past financial disasters is the most powerful tool to protect money and make informed decisions today. The Great Depression didn't just happen, It was engineered by a combination of human psychology, institutional failure, and unregulated markets. Ask yourself, if history rhymes, are we prepared for the next financial storm? If you found this breakdown illuminating, subscribe to Financial Archeologist for more deep dives into how money, power, and history intersect. Hit the like button to support the channel and comment below. What lesson from the Great Depression do you think applies most to today's economy?